Well, welcome back, everyone. We took a couple of weeks off there. I was actually out on spring break with my family for a little while there, and the markets actually ripped higher in my absence. Maybe I should go on vacation a little bit more often. And I think it actually just tells you the market doesn't wait for anyone. What we've seen in the markets is following close to a 10% drawdown in the S&P 500 when the war in Iran began. We've actually seen the market come roaring back. We're back at an all-time high if you look at the S&P 500. In fact, we rebounded to an all-time high in 11 trading days. So that is the fastest going back in about 75 years. If you look back at previous drawdowns that exceeded 8% in the S&P 500, this is the fastest return to a new high since 1950. So I think it's also a very good reminder that the market, at least over the short term, can do things that maybe surprise us. And it's why we don't want to give into emotions and panic at times like this. We know there's still a lot of uncertainty. The ceasefire that was announced recently, it is set to expire here on Wednesday night. As we're recording this, we're hearing talks that President Trump says he does not expect the ceasefire to be extended. So we'll see. As Yogi Berra said, it's not over till it's over. So we can't celebrate just yet. I can certainly point to reasons to explain why the market has been behaving the way it has, but I could also support the case that maybe things have, we've gone from a short-term oversold position to a short-term overbought position here, at least over the near term. So we're remaining neutral as far as our equity stance goes. We came into the conflict positioned appropriately, and so we haven't made a lot of changes to the portfolio. We are continuing to watch things. One of the reasons that the market has really rebounded so sharply is we were watching earnings estimates. And we noted that they continued to move higher, which was a little bit of a surprise, but I think many would be surprised to hear that earnings estimates for the S&P 500 have actually moved higher in every single week since the conflict began. We are now in the earlier innings of the current earnings season, so we're starting to hear from companies. We started off with hearing from the banks last week. We'll hear from more in the coming weeks. And so I think it's really going to be interesting to hear not necessarily about what companies have to say about their most recent quarter's performance, but what they expect going forward. Are they making plans for the next several months as it relates to investments or hiring in light of current uncertainty? So I think that's what we're really waiting on. So far, the earnings outlook remains supportive. So with the announcement of the ceasefire more recently, that, along with the fact that earnings have continued to move higher, I think that gave a lot of people who had moved to the sidelines enough of a reason to get back in. And so we certainly saw that come in recent days. And that's why we are now back to trading to all-time highs. Now, at the same time, if we shift our focus to the bond market, we see that the bond market tells us a little bit of a different story. If we look at the 10-year yield on treasuries, we actually note that treasury yields are still well above where they were just before the conflict began. That is really an acknowledgement that the inflationary outlook is still a little bit of a question. We know that energy prices have moved higher. Because of that, the Federal Reserve is likely to be on pause here with respect to monetary policy for longer than it had been expected, at least at the beginning of the year. So if we look at current pricing, the market is not expecting the Fed to cut rates until next year. So we'll keep an eye on this and see where it goes. But I do think it's interesting to note that the rally in equities has continued despite the fact that energy and oil prices are still 35% higher than where they were before the conflict began. That tells us that there are still some inflationary pressures there. Now, these can be short-lived, but ultimately, as we've said since the beginning of this conflict, it all depends on the duration. If we now think that the ceasefire will hold, maybe there will be some jawboning back and forth. We hope that it's just posturing by both sides as they work out the terms of a long-term agreement. Then we expect that the hit to inflation will be short-term, the hit to ultimately economic growth and the earnings outlook will be short-lived. And so that does support the case for at least a neutral positioning in terms of equities and broader risk assets. And so that's how we're positioned right now. That being said, we are not necessarily out of the woods. So this is still a very fluid environment. And so we'll be keeping an eye on things on your behalf. If you have any questions, please don't hesitate to reach out to your financial advisor. And we'll look forward to seeing you next week.